Hey everyone, welcome back. I hope you're all having an amazing day. Before we jump into today's main discussion, I want to give you a heads up about something that could have a big impact on the markets tomorrow. 1 hour before the market opens, the Federal Reserve's preferred inflation gauge, the PCE report, will be released. This isn't just another data point, it's a key measure that can influence investor sentiment, market direction, and volatility. Alongside the PCE report, we'll also see the ADP employment change released around the same time. So traders and investors need to pay attention because markets could react strongly based on whether these numbers meet expectations or surprise the market. Right now, the market consensus for the PCE is roughly 2.9%, but until the data is out, nothing is certain. Remember last week's CPI report? It was delayed and came out incomplete, which caused a lot of uncertainty. Tomorrow could be similar, so make sure you're prepared for some movement, whether you're trading or investing. Now let's talk about a stock that's been grabbing attention recently, Open. This stock has been through an incredible roller coaster over the past few months. Earlier this year, it was trading at just 47 cents per share, and by the summer, it had shot up to over $10 per share. That's a staggering increase in such a short period. But as often happens during times of market uncertainty, it has since retraced about 40% of those gains and is now hovering around $6.50. Looking at the charts, particularly on the 4-hour time frame, there's a notable support range between the low sixes and high fives. Some bullish investors are predicting it could go as high as $82 per share. While that's possible in theory, it's important to step back and look at the fundamentals before making any decisions. Here's the reality. Open has been struggling for years. It's not a new problem, and it's not a company that suddenly became hot because of a new trend. Open went public back in 2010, reached highs of $109, and has since been on a downward trajectory with lower highs and lower lows. Even with the recent hype around AI and new business strategies, the core fundamentals haven't improved. Revenue remains largely stagnant, and the company continues to operate at a loss, roughly $317 million annually, despite generating $4.7 billion in revenue. That's a huge red flag for long-term investors. Even some of the more innovative ideas, like offering a return policy for home buyers, don't solve the underlying problems. While it might sound appealing to consumers, it doesn't change the fact that Open has been losing money year after year. Analysts also project a potential decline in sales for the current year, which only adds to the risk. From a technical perspective, the stock has been showing signs of weakness, with lower highs and lower lows persisting over time. The recent rallies have mostly been short-term pumps fueled by speculation rather than solid business growth. If the stock breaks below its $6 support range, there could be significant downside potential. Some traders might see prices retracing back to previous lows, even as low as $3 or less. That's not a guaranteed outcome, but it highlights the risk compared to the potential upside. This is why Open is being watched closely by traders, considering short opportunities. Shorting, of course, carries higher risk than simply going long, and it's not something beginners should attempt without experience. The key is risk management. Only use amounts you're comfortable losing, and always consider the potential for sudden market reversals. Another important lesson here is that hype can only carry a stock so far. We've seen this pattern before with stocks like GameStop and other highly speculative plays. For a while, excitement can drive prices to extreme levels, but eventually, fundamentals matter. Revenue, profit margins, and sustainable growth ultimately determine whether a stock can hold its value in the long run. So, what should traders and investors take away from this? First, pay close attention to tomorrow's PCE and ADP reports. They could trigger significant market movement. Second, when looking at speculative stocks like Open, always evaluate both technical patterns and fundamental metrics. A stock might look exciting on charts, but without underlying business strength, the risk is high. For those who are more advanced and understand shorting strategies, this could be an opportunity to monitor key support and resistance levels carefully. But for beginners, the focus should be on learning how to read charts, understand financial statements, and manage risk before jumping into high-risk trades. And here's a final reminder, market cycles matter. Speculative rallies can last for weeks or months, but eventually, the market corrects. If a company isn't generating profit or showing sustainable growth, no amount of hype can change that in the long term. Open has been operating at a loss for years, and while traders might profit from short-term movements, it's crucial to always consider the bigger picture. If you found this breakdown helpful and want to stay updated on stocks with high volatility or potential opportunities for both long and short positions, make sure to hit that subscribe button. Drop a thumbs up if this video added value to your trading strategy. And if you have any questions, leave a comment below. I love hearing your thoughts and suggestions for future videos. We'll also be going live tomorrow during the market open to watch these reports and see the market react in real time. The link is in the description for those who want to join. Watching live can give you a better sense of timing, momentum, and how to respond quickly to unexpected market movements. Thanks so much for tuning in. Stay informed, trade smart, and remember, fundamentals and risk management are always key. Don't forget to subscribe and hit the notification bell so you don't miss any future updates. I'll see you all in the next video, and we'll break down the market together step by step.